One forgotten component of Tesla's business has a huge impact on profits. I'm Chase Wilsey with Wilsey Asset Management. And Tesla, well, they reported numbers that were ahead of analyst expectations, but I wouldn't say I was overly impressed by them. Sales, they increased 8% compared to last year, and earnings per share of 72 cents did top expectations of 58 cents. This was a growth of 9.1% for EPS when compared to Q3 2023 EPS of 66 cents. The interesting component that people forget about is revenue from automotive regulatory tax credits. To comply with emissions regulations that are set by authorities, including the United States and European Union, other automakers purchase credits from Tesla. Now, in the most recent quarter, this added $739 million worth of revenue. While this is just under 3% of total revenue, this is essentially pure profit for the company, which means it likely accounted for close to 34% of the company's $2.17 billion worth of net income. As other companies continue to ramp up their own EV and hybrid plans, a big question I would have is, will they need as many credits from Tesla going forward? Also, if there's a change in leadership after this election, will there be a reduction in regulatory requirements that could decrease the need for other automakers to purchase these credits? This could cause big problems for Tesla, as it would lose a very high margin component of its business. It is hard to bet against Elon Musk considering his successes, but I have a hard time recommending this stock since it still trades at around 70, yes, that's right, 70 times 2025 estimated earnings per share. With that type of multiple, we need to see much higher growth for sales and earnings than what we saw this quarter. Elon did mention his best guess for vehicle growth next year is 20% to 30%, which is one reason the stock shot higher after the earnings report. I will say this seems quite ambitious, and I'd be curious where that growth is expected to come from. I would say Tesla bulls, well, they continue to point towards autonomy as a potential reason to buy the stock. But at this point, I would say this is a huge gamble given the elevated level of uncertainty in that space. Elon did say on the earnings call that Tesla has developed a ride-hailing app that some employees in California have been able to use this year, and he expects the service to roll out for public use next year in California and Texas. The company intends to use it for a robo-taxi network in the future. With that said, though, according to a list of permits issued on the California Public Utilities Commission's website, Tesla isn't currently licensed to operate a commercial transportation network company or a ride-hailing service in California. From a regulatory standpoint, I would have to say Tesla is behind both Waymo and Cruise. So if you hold the stock, enjoy the gain from the post-earnings kind of pop, but again, I stay away from Tesla. Stay ahead in the investment world by subscribing to our YouTube channel and weekly newsletter for the latest economic news, expert analysis, and market insights.